Welcome to TheoTrade. This is Don Kaufman. It is June 3rd, 2017, doing the Theo video weekend update. First and foremost, allow me to start with this has been one of the most explosive ripping moves to the upside that we have seen yet. And for, well, bearish traders like myself, it's much to our dismay. But wow, is the shorts are caving in left and right. Now, what I'm going to attempt to do in this video here on the weekend update is really explain to you precisely why, first of all, why the market is exploding to the upside. Okay, everybody's of course going to say, well, there's buyers out there. Well, I'm going to show you specifically why the Nasdaq happens to be outperforming at this point to the upside. It's all about what we term the short gamma squeeze. So let's go ahead and start, okay, with a quick recap of this. Really, this entire move to the upside has been nothing short of phenomenal. And right now I'm looking at the SPX, and in the SPX, you really have to give credit where credit's due. We've actually traded from 2350 and had a straight shot after one simple down move, a straight shot from roughly 2350 to 2440. So this is a 90 handle, which is a 90-point move, and ultimately 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 trading days. So in a little over 2 weeks of trade, you've had a 90 handle move, which, when you first look at this, you're thinking to yourself, wow, that is way outside of any expectations. That's statistically impossible. But the first thing you want to bring up here, and I'm actually going to bring up a drawing tool, and what I've got are all of the expected moves. One of the first things I want to start with, regarding expected moves, and this is something I've been doing a tremendous amount of research lately on, and you can see I've actually done expected moves 3 years back. I have now drawn them all the way back to February, and we're willing to, of course, share this chart, and we're going to do so in the next couple of days. Nevertheless, this is really not, again, the move is uncanny in terms of one directional, right? We've had ultimately one small down day in the last 12 trading sessions. Nevertheless, because there's a few signs of the market starting to crack apart. And what I've talked about extensively lately is how efficient that the market happens to be. So when I say the market's starting to crack apart a little bit, we're actually starting to trade outside of expectations. And I'm actually highlighting that because you could see it last week. Now, last week, trading, when I say trading outside the expectations, well, we were supposed to close, this week. And when I say this week, again, I'm going back again to the into May, all right, just ultimately a week ago. We were supposed to close in and around 2410, 2409. The market exceeded that, but what did it exceed it by? Basically 4 points. So it's almost a margin of error inside of a $2,400 product, right? Moving by 4 points and exceeding an expected move by 4 points is nothing incredibly substantial. But, okay, we did it again this past week. So this past week, we had a really tight expected move. We had a shortened trading week because of the holiday, right? So we had a 4-day trading week. The market started the week right around 2415. We just explode to the upside. Okay. And once again, we were supposed to close inside of 2435. What did we do? 2439. So it's almost identical. We moved 4 points outside of quote unquote expectations. But when you're calculating expected moves, you have to realize there's a lot of different trading firms out there, right? There's thousands of different trading firms, and many of them are trading on expected moves. Not every single equation is the same. So we assume that our expected moves are in the relative average of that. Again, margin of error, 4 points. But what this is, again, is that it's signs to me of inefficiency in the marketplace. So I started to look at this in substantially more depth. And what it turns out that's really going on inside of the marketplace, okay, what is really driving the market to the upside? And of course, everybody immediately goes, well, there's buyers and they're only buying Apple and Google and Amazon and, and Facebook. And if you haven't seen this before, we actually created you know, an Apple plus Google plus Facebook plus Microsoft plus Amazon symbol, and you can look at these companies directly, all right, on a chart, and you can see, you know, the action on an intraday basis. Amazon yesterday, of course, was hot, neither here nor there at this point. But what I want to show you, again, in terms of why the market is really exploding to the upside, as I said, it's about a short gamma trade. And I'm going to explain it, okay, on a chart here to give you a little bit of depth. And I've tried to do this before, but there is something very, very unique going on, and it's a type of an arbitrage that they're involved in. So I'm going to explain it in the nicest, simplest, cleanest fashion. Then we're going to be very forward-looking. We're going to see what's expected next week. Okay. We'll start back here, all right, back in, you know, the end of May. So on a week-to-week basis, you get many, many firms that go out there, trading firms, and they use options, and often they like to sell option premium. Now, of course, for every seller, there's a buyer out there, but let's start with the sell side activity. So right here, and where's here? Okay, here, let's call it, I'm just going to round it to 2380. At 2380, a trading firm goes out there, okay, and they sell premium. So when I say sell premium, they turn around and sell, for example, the 2380 calls, okay, and they sell the 2380 puts. So they sell the calls and they sell the puts. And what do they collect? Well, how much money they collect, that really is what describes this expected move. And I'm just going to kind of round this over here because I can see this goes from about 2380 all the way up to about 2410, that expected move. So let's say in this example, they collect for selling the 2380 calls and the 2380 puts. Let's say that they collect about $30. Now that premium would be a little rich. I know last week we're only expecting about an $18 move higher or lower, okay? The previous week had a little larger expected move. Anyway, let's say this firm collects about $30 for selling the calls naked and selling the puts naked. Now, this is going to be done in size, and tons of trading firms out there, they do just that. But for every seller, there's a what? There's a buyer. So there is a buyer on the other side of this trade. You know, who's the buyer? Well, another trading firm, and I'll explain that as we go. But I want you to think about the firm that's short the 2380 calls. So somebody comes in and they start to buy the market, right? When I say buy the market, there's true buyers, right? Maybe somebody's doing some stock buybacks. They go out there, they start buying Apple. Well, if somebody starts buying Apple, okay, it'll start to move the Nasdaq Futures a little bit higher, which will also move the S&Ps a little bit higher. And I'm using Apple because it's the largest market cap out there. So let's assume it starts in Apple, and Apple themselves, what do? They start to buy. And when they start to buy Apple, it starts to drive the Nasdaq Futures a little bit higher, starts to drive the S&P Futures higher. Then you get this trading firm, and this trading firm collected $30 of premium, but they have to defend the short calls. So as the market drives a little bit higher, okay, what does this firm do? They turn around and they buy. What do they buy? Well, initially they go out and buy ES futures. Okay, why do they buy the ES futures? Because the S&P 500 futures, and they're using the S&P 500 futures against their short SPX position. Remember, they sold a naked straddle or strangle inside of the SPX. Now I know I've got the screen all marked up, and breathe deeply over here. So this is what is often termed dynamic hedging. They're hedging with the dynamic of the market. So the market starts to spurt up even higher because the firm is buying S&Ps. Now think about this, the cyclical nature of this. They're buying to hedge. But the more they buy, the more it triggers another firm doing the same position. That firm has to turn around and buy, okay? Which then in turn, it starts running up and starts running up, okay? And then another firm has to turn around and buy, and then the initial firm has to turn around, and they're buying more futures and buying more futures. Well, an interesting phenomenon is going on right now. The S&Ps actually have some extremely weak sectors. One of those happened to be the XLF. All right. The other one happens to be none other than the XLE. So because there's two weak sectors over here, the S&P futures all of a sudden are not a very good hedge for the firm against what's going on in the SPX. So the SPX is running up, and the S&P futures, okay, on a percentage basis, aren't really doing the job. So the firm then turns and they start trading Nasdaq futures, okay? And these are firms out there that haven't been trading Nasdaq futures, and I want to show you this because there's evidence all over the place. The Nasdaq futures volume, okay, a couple of days ago started exploding. And in this week, this is all hedging activity, right? This is not like, you know, mom and pop went out there like, oh yeah, I really missed out on the Facebook trade. I'm going to go buy that at 153. What's going on is you've got these firms, okay, that are hedging, and their trade is starting to slip out of control. And you'll actually hear this term. It's called negative gamma. And that's what this is about. It's negative gamma. Because they're a negative gamma firm, it means they basically sold premium. The more we go up, the more they have to buy. And again, the S&P futures weren't working well earlier this week. And the reason the S&P futures were not working well for them in the hedge earlier this week is because the XLF, all right, started to falter. The XLE is in an absolute nosedive. The long and short of this, it is a rally. It is a massive rally. It is a short gamma squeeze. You know, people think of the squeeze as like shorts are getting squeezed. Yes, the shorts are getting squeezed, but today hedging alleviates the shorts, meaning that they just continue to buy and buy and buy and buy and buy and buy. And we're stuck right now in this wild cyclical trade. Now, I'll show you even more evidence of this. You're going to find this interesting. This is the Qs. The Qs are representative of the Nasdaq. The Qs are no longer an efficient product. The Qs have expected moves, and in the last 2 weeks, and I'm going to again highlight the last 2 weeks, this is the expected move 2 weeks ago. This is the expected move last week. Want to see something interesting? The market's exploding outside the expected move, exploding outside the expected move. Why? Okay. No more efficiency. They're buying at any rate. They just don't care. Now, they don't typically use the Qs to hedge. The trading firms do not use the Qs to hedge because it's only a $141 product. So you'll see some big volume in here, but not nearly as large as the Nasdaq futures tell the story over here. Everybody's like, no, it's Amazon. Okay, Amazon, take a look. Is the volume really extraordinary? Absolutely not. But the big market caps, after these firms go out and start buying Nasdaq futures like crazy, all right? So if you go out and you start buying these Nasdaq futures like crazy, what's going to happen is in turn, another arbitrage company is going to come in there and they're going to start buying Apple and Google and Amazon and Facebook to offset their risk. It's all, okay, a pure and simple, it comes down to arbitrage. That's it. And arbitrage is looking for these little inefficiencies. It's premium sellers out there. And again, the most evident area is that the Nasdaq futures are legitimately trading, okay, what? About 30 to 40% more volume than they typically do. Now, let's be again a little bit more forward looking. And again, I've got, you know, expected moves in the Qs. I've got expected moves inside of the SPX. Be forward looking. This next week, what is the SPX expecting? We're looking at about a $20 expected move, okay? All that does is takes us from where we currently are, which is what? 23.49. It takes us just shy of 24.60 to the downside, 24.18, okay? The question that you need to ask yourself, though, in this kind of behavior is, when does it unwind? And there's not going to be a definitive answer to that, but what you need to understand, and again, I still am maintaining short positions, and I have to tell you at this point, covering some of my short positions is essential. Did I think the Nasdaq was going to spurt up 63? Unfortunately, you saw this coming, all right? And we saw it coming when we had the S&Ps outperforming the Nasdaq, and then traders dove into the Nasdaq because it was the underperformer. Nevertheless, at this point, you know, everybody that's short is looking to possibly cover. What you have to start to think about, okay, is a very simple context over here. If you know this is all hedging activity and that we're spiraling out of control to the upside, everybody wants to know when the music stops. And again, there's not a great and definitive answer to that, but part of that answer might already lie in a few of the major sectors out there, okay? Is this the shot across the bow over here? The XLE hasn't had an uptick. The XLF, I truly think that the XLF is going to be the most defining factor. If the XLF does start to retrench and head a little bit higher here, which it has not. I mean, you can probably say the XLF, is it in a period of consolidation? You could argue that, okay? Or you could argue it's in a little bit of a downtrend right now. Neither here nor there. Come on, this thing's been waffling around 2350. But I think the answer is found in the XLF. And one of the scariest things in this marketplace, okay, that a lot of people, they're just not listening to the marketplace. They're not respecting some of the moves. You have major sectors that are not appreciating right now. And when you start to look at stuff like the XLF, here's something even more interesting. The volume in the XLF, with it not moving, was still monumentally large. So clearly, markets are hitting an absolute fever pitch. And again, forward looking over here, you know, hey, and I've been bearish forever right now, but being forward looking, look at the bonds. The bonds have actually broken out to the upside. And if this isn't like, you know, the omen for the marketplace, what is going on? What are the bonds market? Now, the bond has flown from 149 to pretty much 155. Okay, this is a monumental move up in the bonds. This is doing the exact opposite of what the world expected in interest rates. Interest rates, which is TNX, has done nothing but go down. Respect the move in the bonds. Why? You got to feel like right now, there's no way that anybody wants to go out and buy Facebook or Apple or Google or Amazon at these levels. And everybody keeps pointing out, who's the monkey that's buying Amazon at these levels? They're buying it because they're buying the Nasdaq Futures in this hedging position, right? How quickly that would unwind. But at the same time that you're seeing this, you know, just insane buying inside of the Nasdaq, the bonds aren't just creeping up, the bonds are exploding to the upside. And the impact to the XLF has been negligible. Watch the bond market. Is it just keep firing warning shot after warning shot after warning shot, or are the bonds finally going to tank? Because if the bonds do tank, that takes the S&Ps a clear shot to almost 2,500. All right? And you really have to consider this bond trade. But at this point, be defensive. This is not a time when you see markets sprinting to all-time highs and people get all exuberant. This is not a time for exuberance. This is a time, okay, to hunker down. Anything you do right now, all right, takes extraordinary risk. Why do I say that? Okay, I say that because we're seeing inefficiency. We're seeing it inside of the Qs. Okay, we've got a multitude of weeks now that have cracked outside of expectations again and again and again and again. And again, these are all warning shots. We have the bonds exceeding beyond what anybody would have expected. But the bond back to 155, okay, is a big heads up. The next move in the bonds over here, if they continue to rally, you just have to be in a duck and cover stance. And at fear of missing the upside is something that shouldn't even necessarily come to mind. I want to thank everybody for joining us here for the weekend update. Join us all throughout the course of this week here at TheoTrade. Have a wonderful weekend. Bye-bye.